Welcome to CNspoon's China Macro 101 series. This week, we'll be focusing on diagnosing China's Forex outflow. The investment community has been focused on China's capital outflow for quite a while, and they have concerns about the data quality, as well as which proxy is the best proxy to look at China's Forex outflow. So we find it necessary to clarify this a little bit. Now, the first important concept is Forex purchase. Forex purchase is the amount of RMB issued or withdrawn from the banking system due to Forex inflow or outflow. It has caused inflation problems in the past for China, as banks have always settled Forex currencies, leading to excessive monetary supply creation. But unfortunately, now it has become a deflationary concern. Forex purchase is different from Forex reserves in that Forex purchase is denominated in RMB, rather than Forex reserves denominated in US dollars. If we look at the historical trend, if we use the Forex purchase position and divide it by the foreign exchange rate at that time, there's always a gap between foreign exchange purchase and foreign exchange reserve. Now, this gap is on average about 500 to 600 billion US dollar. Why is there such a gap? Let's use a very simple model to demonstrate. Now, let's say a bank sells its foreign currency to the central bank in exchange of RMB for 3 times at different exchange rates. The first time at 8, the second time at 7, and the third time at 6. So for the central bank, it records a foreign purchase position of 21 RMB. But if we translate it into today's US dollars, we will get to 3.5, which is different from the actual Forex reserve number at 3. So there's always a gap between the Forex purchase position's USD denominated number with that of Forex reserve. On top of this, the Forex reserve is not always denominated in US dollars, meaning it can invest in other assets such as euros, yen, and other currencies. And also, we don't know if PBOC has a mark-to-market valuation at a monthly basis. So Forex reserve is always different from Forex purchase. This is our first point. Major Western media such as FT has reported on China's central bank hiding its foreign exchange data. Now we have to know what kind of data it is at first. So for the Forex purchase position, there's actually 2 different parameters. The first one is the PBOC figure only. The second one is called the Forex purchase position of total financial institutions. Now this includes 2 parts. The first part is obviously PBOC's own position, and the second part is for financial institutions. Now for financial institutions, there are 2 parts that is part of its Forex purchase position, which is the Forex exchanges in the OTC market and the Forex positions in the interbank market. If we look at the chart to see the relative positions of PBOC and financial institutions, we can find that the majority or the major chunk of the total financial institutions Forex purchase position was actually PBOC's. The financial institutions only account for 7% of the total Forex purchase position. But in terms of flow, there is a sizable difference here. In 2015, PBOC had a total Forex so-called outflow of 360 billion US dollars, whereas financial institutions has an outflow of around 100 billion US dollars. So in terms of flow, financial institution does have an impact. But on the other hand, they only have less than 300 billion US dollars on their books, which means even if they're selling all of their US dollar, which is impossible in this case, it's still very limited compared to what PBOC have here. Now let's take that back a little bit, and just to determine if this is the best sort of proxy to look at FX outflow. For us, this wasn't the best proxy, because there is a better number disclosed by the PBOC, though later than the Forex purchase position, which is called the Forex net settlement volume. The great thing about this particular figure is that you can look at the structure of the data, such as how much did the client sell in terms of total Forex? How much did the bank sell? Did the banks sell on their voluntary basis, or they sell on behalf of their clients. More than that, you can look at the current account in terms of trade, goods, and flows, and also in terms of capital account in terms of FDI, portfolio investment, and others, so that you can have a better sense about why the banks are selling Forex at such a volume, and why, if it's because of its clients or is it because of itself. Now, in 2015, the total net sales of Forex was about 466 billion US dollars, which is approximately the same amount equivalent to the Forex purchase position change. Surprisingly, the banks have a net settlement of 48 billion US dollars, which means the banks is reducing its Forex exposure to create a inflow of FX relative to the clients, which has a huge outflow at about 500 billion US dollars. On top of this net settlement volume data, we have another data called the bank's net Forex receipt on behalf of its clients. What it means is that it only measures the transactions, the real transactions between household together with non-financial corporations. So what it measures here is that they have a transaction, they have such as like a trade or a capital account sort of transaction, which is based on corporate to corporate or customer to customer. And if we are looking at the real transaction sort of volume, the total Forex outflow is about 190 billion US dollars. So the other $300 billion is actually due to companies, households, and other institutions' own sort of FX conversion. So I just wanted to turn it from my RMB into US dollars. And that is actually a even larger amount compared to real transaction-based volume, which is a matter of confidence and also due to some Forex market changes. So in summary, 4 major points. First of all, Forex purchase position is different from Forex reserves. The second point is the financial institution's Forex purchase, excluding PBOC's number, is only about 6 to 7% of PBOC's Forex purchase, so it's a relatively smaller amount. The third point is the net settlement and net receipt volume is a better proxy of FX inflow or outflow because it is on its setup a flow basis number rather than a stock based number. And fourth, the net receipt number is a narrower figure because it only looks at household and non-financial institutions non-cash dealings. What we mean by non-cash dealings here is that it's transaction based. Thanks for watching, and please stay tuned to our channel at CNspoon and also our website at CNspoon.com. We also have a Twitter at ChinaSpoonCN. See you next week.